If you have $2 million saved for retirement, I'm about to show you how you can spend so much more than you think during your go-go years and how spending more early in retirement can actually save you big on taxes along the way. But before I show you how this works, if you're new here, my name is Jacob Duke. I'm a certified financial planner and the owner of Rivertree Wealth, a retirement planning firm built to help people just like you plan smarter and retire better. And if you've accumulated north of $2 million for retirement, you are probably asking yourself how much you can spend every single year. And you also might be worried, hey, what happens if I run out of money, or is that even possible? But to be honest with you, what I've found is maybe the opposite. In fact, I think that you can spend more than all of the different rules of thumb might suggest. So let's look at David and Jessica's situation to see what opportunities they have. Okay, right here, we're going to run through really quickly their net worth, kind of where their assets are, and then also give you the assumptions of their base plan and then see what they can add to it. So they've got about $2.5 million as a total net worth. That's made up of about $100,000 in the bank. They've got investable assets of 1.8 or so. You can see the breakdown here between IRAs on each of them and then that joint brokerage account. Now, that joint brokerage account, that was actually inheritance from about a year ago. So very minimal gains in it. In fact, their basis is about $240,000. So the majority of that 260 is actually tax-free money, which is very important for them, especially early in retirement. They've also got their property that's paid for. It's $500,000 in value there. Now, what do they actually want to accomplish? They said, hey, we just retired. And so what are we trying to do here? Well, we've got $6,000 a month of spending expectation or wants that they want to do. And that's in addition to their cost for health insurance. So right now they're 63 and 64, and they're obviously not yet 65. So they've got to pay for health insurance in the private sector first. And so that's why we built into that a $10,000 per year per person estimated premium cost. Now, that might not be exactly right. It could be slightly more or slightly less, depending on Affordable Care Act subsidies and their intentions behind trying to get those. But we'll use that number kind of as a placeholder to kind of maybe be right in the middle, although it might not be exact for them at this point or for you in your situation. Just know we are accounting for it, at least in that way. Now, they mentioned, hey, maybe getting a new truck. So David was like, hey, I kind of want to get something nice for myself after all these years of hard work. So he's like, hey, we'll check that out in a second. But right now, I've got that built in for 2027, but you can see a $0 balance here for now. They also mentioned, hey, this $6,000 a month, that's our normal, just kind of, not doing anything crazy spending. We do want to take some vacation. So I put in the annual dream vacation budget. This will be for 10 years, okay? Right now it's at zero balance, but I want to be able to show you and show them how much they can spend every single year for those 10 years during their go-go years in retirement. Right now, obviously, they have no more earned income, but they've got their Social Security that will come in at 67. At least for now, we're planning on taking it then. David's would be $3,400 at that point. I think Jessica's was $2,900. Yep, $2,900 there. And so obviously, they're not saving any money, but that is their situation, at least right now. Recently retired, just about $2 million, mostly in tax-deferred accounts. And they're wondering, hey, can we spend more than this? And also, what does the tax situation look like when we do? And you can see right here that when it comes to their retirement success and kind of what that looks like for them, they're not going to run out of money. Everything is going to be totally fine under that $6,000 per month spending budget, plus also having the higher health insurance premiums for a period of time. You can see that notated right here under expenses. You can see their healthcare cost. David's is actually higher this year. Jessica's got a partial year since she already is 64. And then it drops down a little bit once they do get to Medicare age, okay? So this Medicare premium includes a Part B, Medigap or supplement, and then Part D as well. So that's a Cadillac coverage, if you will, that covers everything as much as possible in Medicare. So they're not getting the cheapest options, but at least it's not too high of a cost just yet for them. Now, if we go back, I want to say, hey, David, Jessica, why are we not spending more money? Are we worried about something? Because I want to show you how it's possible to spend more than $6,000 a month. And if we do that, what I wanted to do really fast is let me just bump this to $8,000 just as a number. Just say, hey, what if we spent $2,000 more than what we're projecting to spend now? And then we'll add in the vacation in just a moment. So when we do that, we still are at 100% chance of success. So the odds of running out of money before David gets to 90 and passes away and Jessica 90 as well, we're still in the same spot. You'll notice, though, that their amount of money they end life with is about $1 million less by spending that $2,000 more every single month in perpetuity for the rest of their lives. Now, what's the real goal here? Is the goal to enjoy the money, or is the goal to have more money at the end of life? I would argue that having the ability to enjoy your money and not focus so much on the dollars remaining at the end of life is a smart decision. So they get to actually enjoy things, use their go-go years while they have their health and the opportunity to go and spend. That's the time you want to do it. So my encouragement for them would be absolutely go spend the $8,000 per month, the $2,000 more than you otherwise thought. But what if we added in a couple extra things? What if we bought the truck in 2027 and we put an $80,000 price tag on it? And then also, what if we spent, $25,000 more per year on, vacation and doing fun things with the family? What if we did that? So I'm going to move this over to say spending the $8,000 a month, this new plan. And what you'll see here is we added in the new truck of $80,000 in 2027. And then also for 10 years, $25,000 extra dollars on top of the already $24,000 extra dollars that we're going to spend on vacation specifically. Now, when we do that, here's what happens. You'll notice, yes, we dropped a few percentage points here down to 95%, but in my book, 95% is actually still too high, meaning we can probably spend a little bit more. So you see that goes down just a little bit, totally fine. We see their total net worth at the end of life actually going down as well, maybe cut in half from the original only $6,000 a month spending. But the point of showing you this is you can probably spend more than you think. And here's one of the reasons why. Once we get to 67, you can see that their expenses let's go back and put it under the highest spending plan, the $8,000 a month plus all the vacations added in. You can see here, we've got higher spending, right? We've also got these goals. You can see the truck is built in here in 27 plus the $25,000, adjusting slightly for inflation over time for 10 years. With that being the case, we need quite a bit of money, right? But once we get to 67, we start seeing, we got a partial year for each of them in Social Security, but a first full year is whenever they're 60, within the years at 68 and or 69, the majority of their income need is actually being met by their fixed income sources, okay? So you can see how much difference they need from their portfolio over here on the far right, the net flows section. You can see, I'll come back to taxes in a second and why that's zero there and there and there. But you can see they need $139,000 from their portfolio to do everything we're saying. They need a lot more in year 2, 2027, because of that truck purchase. And then they need this much here. And once you get down to Social Security age, you need minimal distributions. And even then, once we do get to 75, they're going to have some RMDs still left over. So we could even look at Roth conversions in their scenario. But what you'll notice is the RMDs are not overly bearing. They're not too much to handle starting at 100,000 total. We can look at some tax things here in just a moment. But when you first focus on their tax bill year 1, year 2, year 3, it's sitting at zero because right now the system is assuming that they're going to spend down their cash and their brokerage account first and then take from their IRAs second. Now, what I've done is I wanted to tell you that yes, they've got money in their cash and in their brokerage account. Remember that brokerage account, it is mostly basis, meaning the $240,000, it's up to $260,000, so only $20,000 of gains. They can realize those gains in year 1, assuming they're long-term, completely tax-free under the tax gain harvesting method, which I talk about a lot here on the channel. So they're basically able to access tax-free money for the first 2 to almost 3 years, at which point then they've dwindled down their after-tax cash and brokerage money to start spending their IRAs. Now, a lot of people don't like to take their brokerage account all the way down to zero. So what I wanted to show you really fast was, hey, what if there's a way to kind of combine the two? What if I take a little bit out of my IRA every single year to maybe fill up the standard deduction, and the rest of my money can come from the brokerage account? Now, if you wanted to do that, what you can do is refer to this important numbers data sheet, which if you want a copy of this, there's a link below. You can grab it, download it completely free for you. But this is a helpful resource as you plan things out in 2026, and I get a new updated one every single year. So what you can do is you can say, hey, married filing jointly at $32,200, what we can do is we can pull that much money out of our IRA every single year and pay no tax on it, right? So maybe strategically for them, instead of spending down their after-tax cash and brokerage accounts first, they can methodically take $32,200 out of their IRA every single year. And as that, standard deduction increases slightly over time, they can do that. But then also once they get to 65, they get the additional 65 plus bonus deductions. And actually, they might have a couple years of the new big, beautiful bill deduction of $6,000 per person that can be added even on top of that. So there's more tax-free money that could be had out of their IRAs once they do get there. So the thought process is this: what if they combine two different approaches? What if they took a little bit of money up to these amounts here, the $32,200, their standard deduction, from their IRA, and then on top of that, to fill the rest of their need, that's when they can supplement with the brokerage account and the cash. Now, what that would do is that would extend the life of their tax-free years. So if you're paying no tax on your standard deduction, your distribution out of the IRA, and then you have minimal tax or no tax on capital gains or distributions from your bank account or your brokerage, this extends that maybe a couple more years. But here's the cool part. Even by doing that, you're paying less tax now, but you could also end up paying less tax here, because if you think about it, if we're spending a little bit of our tax-deferred money every single year, in effect, we're doing the same thing as a Roth conversion, which means our RMDs, once we do get to 75, would be a little bit lower because we're spending down parts of our IRAs that much sooner. So you kind of get the best of both worlds. You get a little bit of tax-free years, actually a couple more years on the front end, and you get to lower your tax burden on the back end once you do get to RMDs. Now, this doesn't even include Roth conversions, because Roth conversions can absolutely fit into the equation. And I don't want to belabor this too much, but for them, if they were to go with the original plan of only $6,000 per month of spending, you can see they're going to have minimal, tax years right here, all the way up to close to RMD age. So you can see their effective tax rate's basically nothing under those scenarios. Now, what we could do is if they don't spend as much money as they otherwise could, they can do some Roth conversions here. Let's see if they do a 12% conversion at the $6,000 a month spending. Well, by doing that, it's kind of necessary, right? Because they have that much more money in their tax-deferred accounts. Those RMDs would be a lot larger, so the conversions would be that much more helpful. But they would save this much money in taxes if they were under the current plan of only spending that $6,000 a month. Now, if we do the same thing, you can see that this number, this tax savings, will go down if we spend the higher amount. Under the $8,000 a month, it gets cut in by more than half. So the benefit of the conversions actually go down by quite a bit if you're spending more money. Now, and on the surface, that might sound like a bad thing, right? Because Roth conversions are great, Jacob. Duh, we want to do more Roth conversions. But what I'm saying is, don't let the tax tail wag your life. Don't let the tax tail wag the investment dog, but don't let the tax planning actually take over your life because you're trying to save money on taxes by doing Roth conversions. What if you could actually spend more of your tax-deferred dollars in a tax-efficient way and also have less need for Roth conversions because you're spending more? Maybe it's the way to do both, because at the end of the day, they're already going to have enough money at the end of life. What do they need more tax-free Roth dollars for? Maybe inheritance one day if you were to ask them, but in reality, it's not for them to spend in a tax-free capacity. So maybe they could layer on some Roth conversions, and you can see there is a benefit here by even filling up that 12% bracket during the first few years. Now, what you'll notice is, if I go back really fast here to the summary, and then this tab, let's see here, comparison, you'll notice that their tax rate, or their brackets here, are actually a lot more compressed. They only have a few years to do conversions at that 12% rate because, again, they're spending more money and they need more money faster, right? So that's why you'd move up how much your effective tax rates would be. That would move forward in the years because you're spending that much more, that much sooner. So the whole point of showing you all of this is to say that Roth conversions can be helpful, but perhaps a faster spending strategy can help you enjoy life that much more during your go-go years and actually save you taxes along the way if you do it strategically. So if this is something that you're needing help with, or hey, Jacob, that makes sense, but I don't know how to actually execute that for myself, you can book a free intro call with us to see if we're the right fit to help you with your retirement planning needs. Thanks so much for watching. We'll see you in the next video.